Welcome back to the Did You Know channel. If you've been here before, you already know how this goes. Just hit play, sit back, and relax. Or feel free to do whatever you want. Maybe you're cooking, cleaning, driving, or just chilling. You don't need to watch the screen. Listening is more than enough. I try to make these videos feel more like an investment podcast, so you can get all the insights without being glued to a display. Now, if you're new here, welcome. This isn't your typical YouTube channel with flashy thumbnails and a bunch of exclamation marks. I keep it real. No hype, no ads, no pressure. Just my personal take on what's going on in the world of investing, as someone who's in it, just like you. And today, I want to talk about something every investor, beginner, or seasoned should be reminded of from time to time. We're diving into recessions, market corrections, and how to deal with them when they come. More importantly, I'll show you why these dips often lead to the best investment opportunities. So, if you're not in the mood to dig through charts or read lengthy reports, just sit back, grab something to drink, and let's get into it. When it comes to investing, I think it's always good to remind ourselves how the market actually works. And more importantly, that a drop doesn't mean the end of the world. In fact, it's often the opposite. Let's look at some historical data. Since 1950, we've seen 11 recessions. And on average, they didn't even last a full year, about 312 days. What's even more interesting is that the market usually hits bottom way before that, typically after around 169 days. And by that point, the S&P 500 had dropped roughly 21%. Now, the biggest crash we've seen during that period happened not too long ago, in 2008. Some of you probably remember it. The S&P index tanked over 55% at one point. Yeah, that was rough. But if you've been in the market for a while, or if you plan to stay in long term, you've got to expect ups and downs. Corrections and pullbacks are part of the game. The longer you invest, the more of them you will experience. Take minor corrections, for example, drops of 5% or more. These happen 2 or 3 times a year on average. That's completely normal. In fact, we've seen over 350 of them already. So when the next one comes, don't panic. It's just part of the cycle. Then we've got the slightly bigger dips, 10% or more. Those tend to happen about once a year, and there have been 117 of those on record. And finally, the real heavy hitters, bear markets, where prices fall by 20% or more. On average, we get one of those every 3 years. Now, that might sound scary at first, but here's the flip side. These moments often create the best opportunities. It's when the market is on sale, prices are down, and we as investors can start picking up solid companies at a discount. And I think that's something every investor should keep in mind. Don't panic, stay calm, think long term. Market drops aren't just problems, they're also invitations to build wealth. So, when we take a step back and look at it all, market drops aren't anything unusual. They're just part of the investing journey. Sure, they're not fun. Nobody likes seeing the value of their portfolio go down. But when you know what you're doing, these moments can turn into some of the best opportunities. And one of those opportunities, in my opinion, is Nvidia. Nvidia has been, for a long time, one of the most fascinating companies in the entire stock market. When someone says artificial intelligence, the first thing that pops into my head is those 2 letters, AI, and right behind them, it's Nvidia. This company has been deeply tied to the AI space for years, and right now, it holds a massive competitive advantage in that area. If you've been following this channel for a while, you might already know that I've got a personal investing motto: winners keep winning. And Nvidia is the perfect example of that. It's a company that's constantly innovating, staying ahead of the curve, and delivering insane results quarter after quarter. To be honest, I've had Nvidia on my watch list for quite a while now. I've always wanted to own it, but I was waiting for the right moment to jump in. And I think that moment is here. The stock price has dropped more than 20% from its recent peak over the past month. For me, that's a clear signal to start slowly building a position again. Of course, I'm not going all in at once. I'm taking it step by step, buying in little by little. But I do believe just like it's happened before, that what looks like a short-term drop now could easily turn into a long-term win. That's exactly why, in today's video, we're going to dive deeper into what's behind this recent dip, whether it makes sense, and what I think you should know about Nvidia if you're even thinking about adding it to your portfolio. One thing I've been telling myself for years, and it's kind of become my personal investing motto, is winners keep winning. Yeah, it might sound like a cliche, but in the world of investing, it couldn't be more true. The companies that are leading, that have the tech, the products, the demand, they usually keep outperforming. And in my opinion, Nvidia is the perfect example of that. If I had to bet on just one company right now with the strongest competitive advantage in artificial intelligence, it would be Nvidia. No hesitation. It's not just that they make powerful chips. A lot of companies do that. It's that Nvidia is several steps ahead of everyone else. And that's not just my feeling. The data backs it up. They've been dominating the market for years. They're investing billions into R&D, and they have the kind of know-how that most competitors just can't catch up to. I'll be honest, I've wanted Nvidia in my portfolio for a long time, but I was waiting for the right moment. And now that the price has pulled back, I finally see a chance to start building a position again. Over the past month, the stock dropped more than 20% from its peak, and that's not a small move. These are the moments when I like to take a step back and look at the numbers, the bigger picture, and ask myself, is this it? Is this the time? So, yes, after waiting a while, I've started investing in Nvidia again. Not all at once, but slowly, bit by bit. Because when you believe in a company's long-term story, it's not about timing the absolute bottom. It's about being part of the journey. Now just imagine you're a company like Meta, Google, Amazon, or Microsoft. You know that without serious computing power, you're not going anywhere in the world of AI. So, what do? You start spending not millions, but billions. And that's exactly what's happening right now. Just these 4 companies are planning to spend a mind-blowing $318 billion in 2025 on their infrastructure. To give you some context, in 2024, that number was only $231 billion. That's a 37% year-over-year increase. And remember, this is just the tip of the iceberg. We're not even talking about other major players yet. Companies like Oracle, OpenAI, Tesla, all of them are also pouring money into cloud, data centers, and AI technologies. And now, let's ask the obvious question. Who's going to end up with a huge chunk of that money? Of course, Nvidia. Their graphic processing units, the powerful chips that drive AI computations, have become the industry standard. And if you take a look at how Nvidia's revenue exploded after the last round of spending from these tech giants, it's honestly insane. We're talking about profits reaching up to $130 billion. And here's the crazy part. These companies' spending didn't even increase that dramatically. So, how's that possible? In my opinion, the answer's simple. Nvidia grabbed a bigger and bigger slice of the pie. And that's exactly why I believe we're still far from seeing the peak of what this company can achieve. What happened with Nvidia after the big tech companies started ramping up their AI spending? Honestly, I think the only word for it is unprecedented. Their revenues just took off like a rocket. We're talking about growth of over 100%. And that happened even though the spending by those other companies wasn't increasing that dramatically. Why? Because Nvidia keeps increasing its market share. They're grabbing a bigger slice of the pie, and their competitive edge is so strong that it's hard for anyone else to catch up. So, what are analysts saying? Well, future projections show that growth will start to slow down, which totally makes sense. The bigger the numbers get, the harder it is to keep multiplying them. But even with that in mind, the upcoming forecasts still look insanely strong. For example, in 2026, Nvidia's revenue is expected to grow by 57%. In 2027, it's projected to grow by 27%, and in 2028, around 14%. Sure, that's not the same explosive growth we've seen recently, but most companies would kill for numbers like that. But here's the thing. I personally believe Nvidia could still outperform those expectations. And here's why. The company itself believes that total spending on building data centers, the backbone of everything AI related, will exceed $1 trillion by 2028. And if you realize that Nvidia is the #1 name in GPU technology, it's pretty obvious that a massive chunk of that money is going to land right in their balance sheet. Sure, Wall Street is currently expecting Nvidia's growth to slow down a bit, but honestly, I personally think the analysts might be underestimating things here. Nvidia itself believes that total spending on building data centers, which are absolutely essential for running AI, will exceed $1 trillion by 2028. And if you've ever looked into who owns the biggest market share in GPU chips right now, then, Nvidia is the clear #1. So, what does that tell me? A huge chunk of that money is going to end up in Nvidia's hands. And it's not just about revenue growth, it's also about performance and how well the company is actually run. Take their gross margin, for example. That's basically how much money the company keeps after covering the cost of production. Nvidia is sitting at an insane 75%. And to put that into perspective, one of Warren Buffett's golden rules is that a quality business should have a gross margin of at least 40%. So, yeah, Nvidia isn't just checking the box, they're crushing it. Now, management did mention that this margin might temporarily dip to around 70% earlier this year, but they also expect it to return to the 75% level by the end of fiscal year 2026. And honestly, if a company in a competitive tech space can hold on to margins that high for that long, that says a lot. So here's the question: how can a hardware company like Nvidia manage to pull off margins like that? And this brings us to the reason why Nvidia can afford such insanely high margins, even though technically it's a hardware company. The answer: their technology. Nvidia isn't just working with one top-tier architecture. They've got two of the most advanced ones in the world, built specifically for high-performance AI operations. The first one is Hopper, which you might already know, but the second and currently the most powerful was officially introduced in March 2024. It's called Blackwell. And that, to me, is the key reason Nvidia is still several steps ahead of everyone else. These architectures aren't just powerful, they're designed specifically for AI. That gives Nvidia a massive edge over the competition. In fact, Wall Street got caught off guard again recently. Analysts expected Nvidia to sell around $9 billion worth of Blackwell chips last quarter. The actual number? Over $11 billion. That just shows how strong the demand is. Way beyond what most people had in mind. And when you start digging into the numbers, whether it's their balance sheet, cash flow, or margins, it honestly feels like you're looking at a money machine. Nvidia keeps improving efficiency, boosting profitability, and maintaining its leadership in the market. And here's the exciting part: they're not stopping. This year, they're expected to roll out a new generation of chips called Blackwell Ultra. And then in 2026 and 2027, we'll see the Rubin and Feynman chips. So it's not just that they're winning now, they're setting themselves up to stay ahead, 2 or 3 years into the future. And so far, it looks like it's working. Now let's get into something that probably interests most investors the most: the numbers, specifically the margins and valuation metrics that help us figure out whether a company is expensive or not. Let's start with the net margin, which is currently sitting at 55.8%. And honestly, that number is insane. It means that for every $100 Nvidia brings in, they keep almost $56 in pure profit. For a company that makes hardware, that's almost hard to believe. Normally, you'd expect that kind of margin from a software company, but a hardware firm, and yet, here we are. Their net profit is around $72 billion. And this is exactly why I think a lot of people still don't quite understand Nvidia. Many look at the stock and go, it's already too expensive. Just a few years ago, it had a market cap of $120 billion, and now it's worth $2.65 trillion. And I get it. On the surface, it does seem that way. But then you take a closer look at the PE ratio, price to earnings, and it tells a very different story. Turns out, Nvidia is actually cheaper now than it used to be. The lowest PE it's had over the past 5 years was 36.4, and just recently, it dropped below that again. Right now, it's sitting around PE 40, which honestly isn't bad at all, especially when you consider how fast this company is growing. And get this, over the next 12 months, Nvidia's PE is expected to drop even lower, down to about 25.9. So, when someone says the stock is overpriced, they might just be missing the bigger picture. And then we've got another important metric, PEG, or price to earnings growth. Basically, it's the PE ratio adjusted for how fast the company is expected to grow. And there's a simple rule here. If a company has a PEG below 1, it's considered undervalued. Now guess what? Nvidia is the only company in the entire Magnificent 7 group with a PEG under 1, which means in terms of growth relative to price, it's currently the cheapest of all the major tech giants. And as an investor, that's not something I can ignore. When we talk about Nvidia, there's one question I've been hearing more and more lately. What about AMD? Isn't it cheaper? And honestly, I get why people think that. If you look at market cap, AMD is about 1/12 the size of Nvidia. So yeah, it feels like it should be the better deal. But once you start digging into the actual numbers, the picture looks completely different. Take the PE ratio, price to earnings. AMD is currently sitting at around 99, while Nvidia, even with a much larger market cap, is around 39 to 40. So in terms of earnings, Nvidia is actually cheaper than AMD. And it's not just the PE. If you look at price to free cash flow, AMD is trading at about 67 times its free cash flow. Nvidia, around 46.2, again, cheaper. The same thing goes for the PEG ratio, and once again, Nvidia comes out ahead. So when I put all of this together, I'm looking at a company that's the clear technology leader, has better efficiency, higher profits, stronger margins, and it's actually cheaper than the competition. Yeah, for me as an investor, that decision's a no-brainer. I'd much rather buy the market leader that also happens to be undervalued. Because finding a combination of quality, growth, and reasonable pricing, that doesn't happen every day. Now, let's take a look at another really important metric that often gets overlooked, free cash flow. Nvidia has been absolutely crushing it here too. They recently hit a new all-time high with a free cash flow margin of 46.6%, which translates to $61 billion in free cash. And that's not the end of it. Wall Street is actually predicting that this number will more than double over the next 2 years. Operating income is expected to climb to around $132 billion, while expenses are projected to grow only slightly by about 30%. And what does that mean? Even bigger margins, even more free cash flow, and in turn, a higher company valuation. So here's the million-dollar question. What exactly is Nvidia doing with all that money? And this is where I think the company is doing something really smart: share buybacks. A lot of people don't pay much attention to this, but for me, it's super important. Just take a look. In the recent period, Nvidia has spent over $40 billion buying back its own shares. And while that might fly under the radar for casual investors, the truth is it artificially boosts the stock price. And that's great news for us as shareholders. Because when a company isn't just throwing money around but reinvesting it into itself, it reduces the number of shares in circulation, which means the value of each individual share we hold goes up. So, not only is Nvidia growing through revenue, margins, and innovation, but it's also increasing shareholder value in one of the cleanest ways possible, through strong cash flow and smart buybacks. And in my opinion, that's a seriously powerful combo. Now, let's talk about what excites me the most, the future, what Nvidia has planned, where the whole AI industry is heading, and why I believe we're nowhere near the peak yet. Let's start with TSMC, the world's largest chip manufacturer. They're planning to invest over $100 billion in the United States. And of course, they're not planning to do it alone. They've partnered up with some of the biggest names in tech. including Nvidia, AMD, Intel, and Broadcom. And what does that mean for us as investors? It means Nvidia has strong strategic partnerships that can help them streamline production, deliver chips faster, and possibly even cut costs. And we're not just talking vague ideas. There are concrete plans already in motion. For example, OpenAI and Oracle are currently planning to purchase around 64,000 Nvidia Blackwell chips for their new data centers. And there's the Stargate project, which you may have heard about. It's expected to open 10 new locations, bringing in another multi-billion-dollar investment into AI infrastructure. Now, picture Elon Musk, who just bought 1 million square feet of property in Memphis. And guess what he plans to do with it? Yep, fill it with 1 million Nvidia GPU units, scaling up capacity from 100,000 to 10 times that amount, just within this year. But it doesn't stop there. At a recent Nvidia conference, the company announced it wants to focus on something they're calling physical AI, bringing artificial intelligence into the real world. Their goal is to enter markets with over 100 million autonomous vehicles, a billion robots, tens of millions of factories, and hundreds of thousands of warehouses, all powered by Nvidia technology. And here's what I find most interesting. AI isn't just some software you can run on any machine. To really work the way it's supposed to, AI needs massive computing power, and that can only be delivered by high-performance GPU chips. Traditional data centers built on CPUs won't be enough anymore. They'll need to be modernized and upgraded to GPU-based infrastructure, and that opens up a whole new market, where Nvidia is already in a dominant position. One more thing that really stood out to me, the lifespan of GPU units in high-load data centers is only 3 to 5 years, which means companies will need to replace them regularly, creating a long-term and recurring demand. So, if you believe, like I do, that AI will play a bigger and bigger role in everyday life, from cars to warehouses, then it makes total sense that Nvidia will continue to be a key player in making that happen. Now, let me share how I'm personally approaching all of this, because investing isn't just about the numbers. It's also about how you behave when a real opportunity shows up. Nvidia has been on my radar for a long time. I've been following the company for years, just waiting for the right moment. And in my opinion, that moment is now. The stock recently dropped below its 200-day moving average, which for me is usually one of the first signals that it might be a good time to start entering. But, and I'll be totally honest here, I don't have a big pile of cash just lying around to throw at it all at once. So, I'm doing what I believe makes the most sense. I'm buying in pieces. Every month, whenever I've got a little something extra coming in, I allocate a part of it to building up this position. It's nothing fancy, but it's a system that lets me keep investing, even if conditions aren't perfect. And most importantly, it's mentally easier. I don't have to time the bottom. I don't have to wait for the perfect moment. I just build my position gradually. And if you've been following this channel for a while, you already know that Nvidia isn't the only stock I hold. I also have Micron in my portfolio, a company that's also strongly connected to AI. Not in the same way as Nvidia, with computing power, but through memory, specifically DRAM, which is just as essential for running AI systems. And I'm expecting some solid returns there too. So, it's not just about one stock. It's really about the overall strategy. Looking at long-term trends, spreading the risk, and not freaking out every time the market wobbles a bit. So, to wrap it all up, I honestly think it's pretty clear that Nvidia still has a massive amount of room to grow. They dominate the AI space. They've got cutting-edge technology, insanely high margins, strong partnerships, massive free cash flow, and on top of all that, the numbers show that from a valuation perspective, they're not overpriced at all. Whether we're talking about chip development, expanding data centers, physical AI, or share buybacks, it all fits together. And when I look at this from an investor's point of view, I keep thinking, if not now, then when? Of course, nobody has a crystal ball. Markets are unpredictable. There can always be a pullback or some unexpected event that shakes things up. But if I believe in the long-term power of artificial intelligence, in computational performance, and in where the world is heading, then Nvidia is one of those companies I truly believe should have a place in my portfolio. And now, I want to hear what you think. Drop a comment below and let me know your take on all of this. Do you believe AI will play an even bigger role in our lives? And what role do you think Nvidia will play in that future? I really enjoy reading your thoughts, and as always, if you've made it all the way to the end, thank you so much. I truly appreciate your time, every like, every sub, every share. I run this channel in my spare time, and your feedback honestly keeps me going. Take care, and I'll see you in the next video.